Longterm. Okay. So as Julia said, the paper is called The Determinants of CO2 Prices in the EU ETS system. EU ETS system stands for European Union Emission Trading Scheme system. And the paper has been co-authored with Julia and Alex. So if you have difficult technical questions, please direct them towards them who did the empirical part.
Perdonad, pero otra vez estamos con que no se oye, perdón.
¿Y así? ¿Así se oye mejor?
Quítate la mascarilla, yo creo.
¿Sí?
¿Sí? ¿Ahora?
¿Ahora mejor?
Se oye bajito. A ver.
¿Y 700? Y ahora intenta moverme porque es... A ver, ahora. ¿Así mejor?
¿Sí? Yo creo que sí. Canta.
Canto. Así mejor, avisadnos por favor.
Sí, un poquito mejor, sí.
Listo, de todos modos estamos grabando. Lo siento.
¿Lo oís a mí? ¿Lo oís a mí de
Ahora
mí?
se oye bien.
¿Con el micro?
Es que así va a cantar pero moviéndose. ¿Lo oís, no? ¿Me oís en casa o no? O en casa, donde estéis.
Sí, mira, sí.
Sí.
Sí que te mueves.
Pues ya.
¿Eres tú, Alejandro?
Sí, es Alejandro.
Así que parece
Se os oye, se os oye.
Genial. Bueno, uy, qué nerviosa me he puesto con el micrófono. La estructura de... en inglés. So the structure of this presentation, I'll open with the motivation and explain a little bit of the context for this paper. I'll go through the modeling strategy, talking you through the theoretical model, the data, the empirical strategy. I'll move into the results and policy implications. Please, if you have questions, do not wait until the end, especially because we've started so late. Just interrupt and yeah, hopefully we can answer them. Okay, so the paper is about carbon prices, or prices of the CO2. Carbon pricing is thought by many economists to be the key market instrument for climate change action. Such organizations as IMF are advocating for carbon price floors internationally because they do believe that it is the most efficient or effective economic mechanism to combat climate change. How does this instrument work? So ideally, in general, there are two types of carbon pricing to be implemented in the world. We have carbon taxes on one hand, so it's just price of fossil fuels will be incremented by the tax that would correspond to the carbon content of the fuel. And the other possibility is emission trading scheme. That is the market for emissions. That's something that we have in the European Union. What is the idea of pricing the carbon? Well, essentially, we know that carbon emissions represent an externality that is not being priced in many places of the world. So if we are able to put a price on it, and this price will be sufficiently high, the installations that are emitting would have an economic incentive to switch to cleaner production, or maybe not to produce, or to innovate, etc., etc. And the closer the carbon price is to the social cost of the carbon, the better. So once we've achieved the social cost of carbon, the externality is not present anymore, the problem solved. We are very, very far from there. The social carbon price is thought to be at least 75 euros per ton, and we are nowhere near that. So European Union is really proud of the way it's handling the problem. We do have a market for the emissions here. It's called European Union Emission Trading Scheme, and this is the extract from the webpage. They're very proud. It's the biggest carbon market in the world. How the market works: we have supply and demand forces. We have the supply, who is fully controlled by the Commission. Each year, the Commission decides how many carbon allowances or permits to emit will be issued, and this quantity is fixed. But they reduce this quantity year by year. So the system has been implemented in 2005 for the first time, and they started with the stock of emissions per year. And they were gradually reducing this stock of emissions available by 2 to 3%. As you probably know, since 2026, with the new Fit to 55 package, the rate at which the total stock of emission will be going down will accelerate, and it will be 4 to 5% each year. So that's on the supply side. When the emission trading scheme started back in 2005, we had a lot of installations that would receive the permission to emit for free, but we gradually see this free allowances going down as well. So that's the supply. What's on the demand side? You have all of the installations, so in order to be able to emit, they need to pay for it. It's essentially an auction scheme, but there is also a secondary market. What determines the demand for emission permits is obviously the level of production of that installations. It is the energy demand and emission intensity of the fuels that the firms use. If you look back in the literature, but also in the policy reports, there is a consensus that European Union emission trading scheme was not functioning well and did not deliver the good result up until 2018-19. So up until that moment, we saw average price of CO2 around €5. When we started writing this paper, the prices went up really fast, and I think it was 15 to 20 euros, and we thought, wow, it's a huge increase. The last time I checked, a couple of days ago, it was 63 euros. So you can imagine a lot of things changed, and as just to anchor the expectations of the social cost is thought to be at least 75. So even though we saw a dramatic increase, we are not yet at the social level. Okay. Another thing to know, and hopefully it also adds a bit more to the relevance of this paper and the problem as a whole, the European Union emission trading scheme will be extended to include transport and building sector in 5 years' time. That is, to be able to use petrol or diesel or natural gas at home for heating, our price will be increased again because we will be paying for the emissions as well. So the market itself will be increasing, and yeah.
So, may I interrupt you, Iryna? So why was the price so low up until 2018?
That's a great question. And why is it so high now? So there are many explanations really, and I think a useful illustration will be financial crisis. So because of how this system is designed, the Commission said beforehand how many allowances they will put on the market. But in the financial crisis, the activity went down. So there was not enough demand for these allowances. So they ended up costing, I don't know, €1, €2, just because, the industry did not produce what they needed to produce. And overall, it was a flaw in the design. Many actors say it was not ambitious enough in bringing it down. Some claimed that the market themselves, the secondary market, didn't work well. Some claimed that too many free allowances were gave up for free. There is no single factor, but hopefully this is all dealt with by now. Yeah.
Okay, thank you.
So this hopefully brings us to the understanding that it would be really nice to understand what determines the prices of the CO2, especially understanding that it is a really complex system where the energy market, carbon markets, and economic activity side of the things are interconnected, and it's not really that easy and obvious how and what determines what. So the goal of this paper is to investigate what determines the dynamics of the carbon price. So we obviously are not the first people looking at this question. A lot of authors have been analyzing the carbon markets. A lot of people have been looking at the determinants of the carbon price. Empirically, it has been proven that fuel prices are closely connected to the carbon prices. Economic activity is also one of the important determinants. Some of the authors pointed out that the relationship between these factors changes over time, so it's not the same now as it used to be. And obviously, many other authors use quantitative techniques of different degrees of sophistication to quantify these impacts. We say we add to this stream of the literature in 3 ways. We first develop a very small theoretical model that gives us really clear suggestions of what variables need to be included in our empirical model. That is something that many of the authors, well, I think nobody in the literature we looked at has done before. We also look at the impacts of these variables in 3 different frequency ranges, long run, medium run, and short run. And finally, we represent the model with our structural VAR framework and use spillover and connectedness indices to quantify the impacts of the one part of the system on the rest. I don't want to really spend a lot of time explaining the theoretical model, but I'll say a couple of words. So we'll start with defining the price of CO2 as a function of supply, which is fixed, Q bar, and demand. We then open up the demand, and we know that the demand for CO2 comes from 2 sectors right now, because transport and buildings are not there yet. So we have electricity and we have industrial production. We open up electricity, and we know the electricity only uses natural gas and coal for now in the European Union. So we use the demand for gas and demand for coal with respective emission intensities alpha. We then transform this equation to express it as share of fossil fuels in the electricity production, average emission intensity of the fossil fuels in electricity, and demand for electricity. We do something very similar for industrial production, but we have 3 components here. We have oil, because some of the industrial processes still use oil or derivatives for their production. We then sum them up, log linearize, and we come up with sort of linear logarithm of prices as a function of the following variables. Fixed number of the permits in each year, aggregate output, because the aggregate output would determine the demand for electricity, but also for the industrial production. The share of fossil fuels, the prices of oil, coal, natural gas, and electricity, and CO2 prices, obviously. That's how that addresses the first point that I mentioned, that we did have a clear framework to how to come up with the variables that need to be included.
So you mentioned before that supply is not fixed, but every year they were increasing the number of permits, but at a decreasing, the number of new permits, but at a decreasing rate, right? So they were giving out new permits, but over time at a decreasing rate, right?
So you need to buy them every year. So if you keep producing, for every ton of CO2 that you emit, you need to buy paper that says that you're allowed to do that. Right. So again, if you want to emit another ton next year, you need to go to the market and buy another paper.
Sure.
So what happens with the total number of the papers that the European Union issues is that it goes down.
The total number of papers goes down.
So it is, 100 units in year 2005, it's 95 in year 2006, 90, 85, to illustrate the point. So it was going down at 2-3% rate, and now it will go down more steeply.
Right, so the supply is decreasing then, right?
So the supply is fixed for each year.
For each year, yeah.
And it's known beforehand, so we, or at least we think we know, unless the policy changes, how the total number of permits will evolve. So it means that the competition and the sort of demand pressure will be higher and higher for each next year, because So we've got this vector x that composes, I think, 7 variables that would form part of our estimations. So as I said, the share of fossil fuels, total economic output, price of oil, price of natural gas, price of coal, price of electricity, and price of CO2. So what we do, we estimate a reduced form vector autoregression with all of these variables. We use the recursive identification, and we assume that each variable is not affected contemporaneously by next variables in the vector, meaning that we believe that share of fossil fuels does not depend on any of the variables there, and the last variable, which is price of CO2, is defined by everything, right, and something in between. We then distinguish between fundamental shocks and market-specific shocks just because we are looking at different frequency bands. So what we say is that whatever impacts we observe in the long run, this must come from the fundamentals, because like that's what the economics tells us, that's what the equations tells us, whatever. Whatever relationships and fluctuations we observe in the short and medium runs, these are more likely to be market-specific shocks not caused by the fundamentals, or speculative shocks as well. So that's we estimate our bar over the rolling window. The size of the window is 156 observations, and we use weekly data. The frequency ranges defined as follows. So the high frequency band is everything which is less than 4 weeks. The medium frequency is between 5 and 26 weeks, and the low frequency or long run is a period longer than 27 weeks.
So this market, another question, this market is open every day. Is it open every day? No.
So there is primary market and there is secondary market. The primary market is an auction essentially. So the commission says, this day I will be selling all of these permits. So people would go and buy, but then you have the secondary market, which is really fluent and liquid, and that's why you have daily prices.
So this data come from the secondary market,
Exactly.
right?
Yes, because that's the only liquid market.
So why didn't you use the daily data maybe?
Because we have other variables at higher frequency. For example, share of fossil fuels in electricity production, we have it just monthly.
Yeah.
Okay.
I'll touch on that. So yeah, if we wanted, we could have hourly data for most of the variables if we really wanted. So the thing is that frequency is not useful if we have another variable that is only monthly and we have a result of the lag. Okay, so just a couple of definitions and clarifications. In the graphs, when I speak about the results in the graphs we will be looking at, we'll be looking at different expressions of the percentage of the variable, or percentage of the variance explained by different variables. So we compute the percentage of the variance in each of the variables attributed to the shocks in each of the other 7 variables that are in our vector at each of the 3 different frequencies. In this paper, in this presentation, we will only be looking at the equation of the CO2 prices. So in a way, we are computing what percentage of the variance in the price of CO2 can be attributed to the shocks in the variables, such as price of the natural gas, price of the oil, etc., and own price shock. It's only interesting to look separately at short, medium, and long run, and nothing in between, so we'll only concentrate on those. Within connectedness, at the band, one of the 3 bands, is the percentage of the variance attributed to the shock in a variable at a specific frequency without taking into account the importance of each of the frequency bands. Right, so it's, we look at all of the variance in the long run, and we just decompose in a way this variance between coming from explained by different variables. We do the same. We do the same for medium and for high frequency band. When we take into account the importance of each of the frequency bands for the total variance, we call this frequency connection. And the last but not least, from connectedness measures the total of the variance in CO2 prices that can be explained by all of the variables in the model, which is not the own shock. I hope, I'm sure I haven't done it really well, but I hope when we look at the graphs it will become clear. So on the data, we collect all the data that we need for the vector that I have just described. In terms of fuel and CO2 prices, we look at the first monthly futures of the publicly traded contracts. Why futures? Why don't we look at the spot prices? You probably ask, because these are the most liquid assets. So these are the markets that are most developed. The trade volumes are the highest, and that's why all of the majority of the literature uses uses these measures. So for oil, we look at Brent. For natural gas, we look at TTF contracts. For electricity, we look at German base prices. And for CO2, we look at ICE futures, although it doesn't really matter because all of the prices in that case would be exactly the same. The economic output variable is coming from the economic activity index stocks for the European Union. And the most problematic, in a way, variable is the renewable electricity share, or the other side of share of the fossil fuels used for electricity generation is coming from Eurostat, and it is only available on the monthly basis. So essentially what Eurostat does, they receive the official reports from all of the ministries of energy for each of the member states. They will add them up, put them in the Eurostat, and if I go now, the latest data I will see, I believe, is 2019. So I wanted to update the results of this, and the variables it's really difficult to obtain, unfortunately. Geographically, the scope of our analysis covers European Union 28. I know it doesn't exist anymore, but for the period of the analysis, in our data, UK was still part of the European Union, and obviously was part of the emission trading scheme. So being restricted by the availability of the renewable electricity share, our data starts in 2008 and ends in 2018. That's why when we calculated it for the last time. As I mentioned at the very beginning, we have this fixed supply each year, right? So ideally, we would also want to control for the total number of allowances that the Commission puts on the market. Unfortunately, because we only have it every year, we cannot really do much, and our sample doesn't run for that many years. So we can include it as one of the variables. So what we have done is we have subtracted the average CO2 price, the average yearly CO2 price from our CO2 prices, CO2 data, and we said that that's the way we've eliminated the supply side, and we are only looking at the demand side shocks in our work. Fine, results. Whew. Okay, so the first graph shows us what share of the variance in CO2 prices can be explained by all of the rest of the variables that we have in our model, right? All of the prices of fossil fuels, economic activity, etc., etc. The colors. The black line is the total variance. The red line is the low frequency or long run effect component. What's the color? The green one is the medium run, and the blue line is the short run, must be. As you see, the red line is very close to the black line. I'm dyslexic in colors today, which means that almost all of the variance that we see in the CO2 price fluctuations is attributed to the fundamentals. That is, it is being transmitted over the long run, right? So it doesn't mean that our model variables are not important at shorter runs. What it means really is that all of the dynamics that happens really occurs on the longer run, which is great news for policymakers because that's what they are aiming at, and that's what they are looking at to influence. What else can we see from this graph? We can see that on average 60 or it says 65% of the variance in CO2 prices can be explained by our model. That is, it's quite a lot for weekly data. So all of that happens on electricity markets or oil markets can explain quite a lot of the dynamics in CO2 prices as well. Another thing that we can see from this graph is that the percentage of the variance that we can explain changes quite a lot in different periods. So we have some periods where it's barely 30%, and I bet we have some periods where it's almost 90% or even more. Which means that something changes quite a lot, and we're lucky we have done the analysis sort of in this different time parameter because it's definitely not constant. And we will look a bit later what would explain this different dynamics. The second graph shows you separately how much of the variance in the short and medium run and long run the variables can explain. So the conclusion from this one is that when we look at the total variance transmitted in the short and medium runs, our variables in the model can explain up to 20–30% of the variance, meaning that they're not that important. And we will see the flip side of it. It's own CO2 price shocks that are important in the short and medium run, meaning that these are market-specific shocks or speculation effects. So the fundamentals are not working in the short run, they are working in the long run, which makes perfect sense.
So just to understand, quick question. So on the previous slide,
yeah,
so when you say the long-term component accounts for most of the uncertainty transmitted, I'm not sure I understand what that means. I mean, I'm a bit rusty on all this technology, but I would think that, I mean, what I followed from your talk is that your dependent variables are in levels. So basically you have a model for levels, and then you explain whatever share of the variance of the levels of those variables with your model. And I would not interpret that as the long-term component accounting for uncertainty in your dependent variable. It's just the share of the variance of the dependent variable. Your dependent variable is in levels, so I don't think it is capturing any uncertainty about anything.
I don't feel competent to answer this question. I would like you to answer it.
Okay,
Sorry, I didn't really listen
yes, it is. Can you hear me?
Yeah.
Yes, okay. The idea here is that, yes, in the first graph, what we see percentage of the variance in different frequency ranges. And long run is very close to total because long run variance is very important here. So it's true that if you make estimation in levels, you will have a lot of persistence in the variables, and this persistence is accumulated in the long run, so it's close to frequency zero in frequency domain. So basically, yes, it reflects the fact that variables are very persistent. So because of that, we have so strong long run variance. Okay, I don't know until which point I have replied to your question.
Yeah. I think it's fine. I'm just. I think my point only had to do with one word in
yes,
that,
I understand.
But
actually, because of that, people as well report results on within connectedness, because it does not mean that relation between variables is not important for short run. Okay, if you look just first graph, you can have conclusions that short run and medium run connectedness between variables is not important, but it's not true. It is important, but in the first graph you cannot see it because all your variance is given that it is attributed to low frequency range, you cannot see short and medium run. Because of that.
No, I understand that. What I'm saying is I don't think your model is capturing anything about uncertainty. It's capturing the dynamics of the levels of your variables. So to the extent that you're not looking at the variance of you don't have a VAR for the variance of those variables, I don't think you're capturing anything about uncertainty.
Okay, you capture percentage of the variance attributed to other variables or to other shocks. So
yeah, I think we're probably saying the same thing.
Because it's forecast error variant composition.
Okay, you're speaking about forecast error variance decomposition because
the word uncertainty. Why uncertainty?
Why uncertainty? Okay, I don't know. So
no. I think your problem is the word uncertainty, right?
Exactly.
Yeah, I want to tell you because this is forecast error variant decomposition. So the total variance is a decomposition of the variance of the total at different terms, right? So it's forecast error variance. So it's future variance.
Okay, I see what you mean.
So that's why I call it, so that call uncertainty here you can understand it like variance, but it's forecast error variance. So it's future variance. So you can decompose this total variance
So
to
you
different
mean,
frequencies.
so you mean when you say uncertainty transmitted, you mean the errors, the variance of the errors of your system?
Yeah, exactly. Exactly. That they accumulate each period in the forecast. That is the idea.
Claro. Okay. Thanks.
Okay. Cool. I'm lucky to have you. Okay, let's go quickly through the results, equation by equation. Again, remember we're only looking at the CO2 prices, and then we will have a graph for the effects of each of the rest of the variables on the CO2 prices. So let me explain you how to read the graphs. The first one would show us what percentage of the variance in CO2 prices can be explained by the share of fossil fuels in electricity production in each of the frequency bands, right? The color coding is the same. In addition to that, we have an additional piece of information, which is this blue and red areas. What does it mean? When it is red, it indicates the sign of the relationship. When it's red, it means that the share of fossil fuels goes up, the price of CO2 goes down. The blue area means the share of fossil fuels go up, the price of the CO2 goes up as well. So blue is the positive relationship and red is the negative relationship. So overall, in the whole period, we see that the share of fossil fuels does not explain that much of the variance in the CO2 prices, except for this spike, which is a really weird one and difficult to explain, especially because it is a red area, meaning that the share of fossil fuels goes up, meaning that we have more demand for CO2, and strangely enough, the price of CO2 is going down. So it clearly indicates that something was going wrong in that period and the market was not functioning as it was intended. What happened? Happened that since 2013, the electricity generation plants were not given the allowances for free anymore, and they had to buy them. It generated a lot of uncertainty on the market, it messed up the expectation, the investment patterns, and it generated this kind of things. Luckily, or thankfully, in the latest period, starting 2016, 17, 18, the sign is as expected, the share is not as high, and interestingly enough as well, the medium and short run components are quite high, which is a good thing in a way, and I will struggle to explain why, but I'll try. So share of fossil fuels is not something that we can really control. We have our electricity system being designed as it is right now, and for me to change its composition, it will take quite a lot of time. So only extreme weather events influencing the renewable generation will impact this variable. And that's all right, because it will only have very transitionary impact. So that's why it makes sense that we see this component a little bit high. So let's move on to the economic activity index. As you see, while the relationship is, when we look at the signs, is intuitive. So the more, the higher is the economic activity, the more we produce, the more demand for CO2 will be, so the higher the price will be. These are the blue areas. What is interesting here is this clear downward trend in this period, meaning that now the economic activity is not as important for CO2 price as it used to be, which is a nice indicator for how our economic growth is being decoupled from the CO2, right? So before, when my economy was growing, it had a huge impact on CO2 price, meaning that it really affected the demand for CO2. It doesn't happen anymore. It means that I can grow without really introducing the distortions on CO2 market, which means that I don't really depend on the carbon that much for my growth. So this thing can be used as an indicator on how green our economic growth is, or when we speak about COVID recovery, how green is this recovery, if we repeat this for now. Equation for oil. I need to say a couple of words about oil. while you've seen in the theoretical part, oil is not directly being used a lot in the European Union, it is really important to include its price because it is an indicator of long-term natural gas contracts because they are being indexed to oil. And here the relationship is as expected. The higher is the price of natural gas, the higher will be the incentive to switch to coal, which has a high emission intensity, which will mean higher demand for CO2, which will mean higher demand, higher price of CO2. Same happens for natural gas, but it is a spot market again. In the last period of time, the signs are as expected, and the share of the variance explained by this variable is also nice. Coal is a little bit remarkable. The sign of the relationship is as expected. The price of coal goes up. We need more natural gas. It emits less. The price goes down. That's all right. Why do we see these increases in the latest period? This is explained by more stringent environmental regulations. So you've probably heard of coal phase out, which also messes up with the expectation and adds up to the price shocks that we observe. And finally, electricity price is not really important for CO2. Why? Because it's the other way around, right? So it's CO2 who will be influencing the electricity price, and that's what we have probably seen in our electricity bills lately. Apart from increasing price of natural gas, the CO2 prices also went up and we ended up paying a lot more. So to wrap up, okay, so far we've seen what was the impact of the rest of the variables on the variance of CO2 prices. These are the results for their own shocks. I think the most interesting one is this one. As I said a bit earlier, the flip side of the very first graph that we saw is that own shocks in price of CO2 explain quite less in the long run, but they explain a lot in the medium and short run, which makes sense. So finally, to wrap up, now yes, we've constructed the theoretical model that helped us to select which variables were important to include in our empirical part. We've estimated our structural VAR. We've quantified the impacts. We've done it on frequency domain analysis. We found strong linkages between fossil fuel prices, our economic activity variable, and share of fossil fuels. We've described it. We believe this model is a really useful monitoring tool for the policymakers. They can first use it to see what happened historically, and we've only seen one equation, so we've only been looking at the price of CO2. We could do exactly the same analysis for the rest and see how one part of the system impacts the rest. So whatever policy I'm planning, if I'm interested in see what impacts on the rest of the system this policy would mean, I could use this model to quantify potential impacts in different scenarios. Another thing that I also mentioned is a nice measure of how green is the economic growth, so how green is the economic activity, because we can link the carbon markets with economic activity as well. So yeah, and finally, you've heard me a couple of times also saying that in the latest period we finally see the expected sign, everything seems to be nice, no distortions, which is a good indicator as well that the market is finally functioning well. And then after 15 years of the market, the European Union has finally managed to design it well, and hopefully it will stay like that. Thank you.
I have two questions. One is, which criteria did you use to establish the thresholds of the bands? This is kind of a usual question, I guess, in this literature, because it also happened last talk, no? And the other one is like, okay, we are with this CO2 permit, no, trading system, but there is this huge debate over this problem of emissions with accountability, no? Because if there are emissions embedded in trade and outsourcing and all this stuff, no, and is this taken into account in this article or in the analysis of these prices? Because I mean, this decoupling might be a kind of a fake thing, or some things might be generating a, you know, like a mirage, because it's not that I'm not polluting, but that I have outsourced the pollution.
Yeah, okay. I'll answer the second question, and then maybe you can answer the first one. But the second one, I find it really fascinating. Thank you. So for this market in particular, the accountability is not an issue because all of the installations really need to report their emissions and they are being verified. So it's somebody's job just to go to a Repsol refinery and check whether they are being emitting what they are paying for. So not a problem at all. On your point of embedded in the train, etc., so you're probably touching on the carbon border adjustments, which is also part of the Fit for 55, right? So to be able to import something to the European Union, China or whoever would need to pay an equivalent price for the carbon that they've emitted when producing this. You probably also know that what the Commission is proposing right now is to link the price they pay to the ETS system. So imagine that, so that's why you don't need to pay anything to export from France to Spain, because they are subject to exactly the same system. But if you want to bring something from China and the carbon price in China is $5 and in the European Union it's 63, so what China will need to do is to compensate for the difference. And what the Commission is proposing is to link it for each year's price observed on the internal market to make it fair and not to disturb the competition inside of the market.
Okay, and about first question, so for us it was more important to separate like long run part from short and medium part. And given that we have just 3 years of data inside window, so we were trying to look for something that it could be what we could call long run. So we decided to take half a year. Okay, and after for short and medium run, so actually what we were thinking that, okay, given that we define a little bit like speculative short, so for the short run we try to find something really short, so it was 1 month. So in reality limits are chosen a bit ad hoc, but given the result, you see that long run dominates everything in variance. I think it would not be very different if we try to move a little bit further, if we try to move to 1 year horizon, from 1 to 3 years. Okay, more questions? No? Okay, thank you.
Thank you.